Here's a number that should bother you. The average American homeowner overpays between $2,000 and $5,000 per year on their mortgage. Not because the banks are stealing from them, but because they don't understand 3 specific rules about how mortgages actually work. Today, we're going to fix that. Stick with us, because by the end of this video, you'll see your mortgage in a completely different light. Let's start at the beginning, and I mean the real beginning. Most people think of a mortgage as borrowing money to buy a house and paying it back over 30 years. But that framing hides the most important detail. When you take out a $400,000 mortgage at 7% interest over 30 years, your monthly payment is around $2,661. Multiply that across 360 payments, you'll pay back nearly $958,000. That's $558,000 in interest alone on a $400,000 loan. This isn't a conspiracy. It's called amortization. In the early years of your loan, almost all of your payment goes toward interest, not principal. In month 1 of a 30-year mortgage, roughly $2,333 of your $2,661 payment is pure interest. Only $328 actually reduces what you owe. Think about that. You send the bank nearly $2,700 and your loan balance drops by $328. This is why the first decade of home ownership can feel like you're running on a treadmill. Your balance barely moves. But here's what almost nobody tells you. This front-loaded interest structure is also your greatest opportunity. Because the same math that makes year 1 painful makes refinancing in years 2 through 7 potentially life-changing. Now let's talk about refinancing, and specifically when it actually makes sense. There's an old rule of thumb that says you should only refinance if you can lower your rate by at least 1%. That rule is wrong, or at minimum, it's wildly incomplete. The right question isn't how much can I lower my rate. The right question is, how long will it take me to break even on the closing costs? Here's how you calculate it. Say you're refinancing a $380,000 loan from 7.5% down to 6.8%. Your monthly savings would be around $170 per month. Your closing costs on the new loan are $7,000. Divide $7,000 by $170, and you get about 41 months, or roughly 3.5 years. If you plan to stay in your home longer than 41 months, refinancing makes financial sense. If you're planning to move in 2 years, it doesn't. This is the break-even calculation, and it's the single most important number in any refinancing decision. But there's a second trigger point most people miss entirely: your credit score. A credit score improvement of just 40 to 60 points can qualify you for a dramatically better interest rate. If your score was 680 when you bought your home and it's now 730, that's potentially a half-point better rate, which on a $380,000 loan translates to more than $1,100 per year in savings. So refinancing isn't just about rates going down in the market, it's also about your profile going up. Here's where most homeowners get burned, even when they do refinance. They focus entirely on the new interest rate and completely ignore 3 costs that can turn a great-looking deal into a financial disaster. Hidden cost number 1: closing costs that get rolled into the loan. Most lenders will offer you a no-cost refinance, meaning you don't pay closing costs up front. Sounds great, right? But what actually happens is, those costs get added to your new loan balance. So instead of refinancing $380,000, you're now refinancing $387,000. You pay interest on those extra $7,000 for the entire life of the loan. On a 30-year term at 6.8%, that little roll adds over $9,000 in additional interest. You paid $7,000 in closing costs, and then paid $9,000 in interest on those closing costs. Hidden cost number 2: prepayment penalties on your existing loan. Some mortgage contracts, particularly older ones or certain adjustable rate products, include penalties for paying off the loan early. Before you refinance, read your current mortgage agreement. Look for the words prepayment penalty or early payoff fee. These fees can run anywhere from 2% to 5% of your remaining balance. On a $380,000 loan, that's potentially $19,000 in penalties. Hidden cost number 3, opportunity cost of resetting your amortization clock. When you refinance, you typically restart at a new 30-year term. If you're 8 years into your current mortgage, you've been slowly building equity through principal payments. A refinance restarts that clock. You might be paying less per month, but you've extended your loan horizon. Run the total interest paid over your remaining life in the home, not just the monthly payment comparison. This chapter is about a trap that catches even financially savvy people. The trap is this: fixating on the monthly payment instead of the total cost of the loan. Imagine you're 10 years into a 30-year mortgage at 7%. You have 20 years left and $310,000 remaining. A lender offers you a refinance at 6.2%, but back to a 30-year term. Your monthly payment drops from $2,580 to $1,900. That's $680 per month in savings. Sounds incredible. But let's do the math on total interest. With 20 years left on your current loan, you'd pay approximately $186,000 more in interest. With the new 30-year refinance, you'd pay approximately $374,000 more in interest. You reduced your monthly payment by $680 and added nearly $190,000 to your total interest paid over the life of the loan. The alternative? Refinance to a 20-year term at 6.2%. Your payment stays similar, around $2,300, but your total remaining interest drops to roughly $240,000. That's a $134,000 saving compared to the new 30-year option. The lesson here is simple. Always model out the total cost of the loan, not just the monthly payment. Your lender won't do this math for you. You need to do it yourself. Now let's put it all together. Here is your refinancing playbook. 5 concrete steps. Step 1. Calculate your break-even point before you do anything else. Take the estimated closing costs, divide by your monthly savings, and make sure you'll stay in the home long enough to recover those costs. Step 2. Shop at least 3 lenders. Rates vary significantly between institutions. Credit unions, online lenders, and your current servicer may all quote you different numbers. A half-point difference in rate is worth the 2 hours it takes to gather 3 quotes. Step 3. Check for prepayment penalties in your current loan documents before signing anything with a new lender. Step 4. Choose your term deliberately. Don't just accept the 30-year default. Model out the 15-year and 20-year options. Your monthly payment will be higher, but your total interest paid will be dramatically lower. Step 5. Consider the timing relative to your credit profile. If your score is trending up or you've paid off significant debts in the last year, waiting even 60 to 90 days to apply could save you thousands by qualifying you for a better rate tier. The mortgage system is designed to be complicated, but the people who understand it, really understand it, don't just save money. They build wealth faster. If this video helped you see your mortgage differently, subscribe to the Loan Desk. Every week we break down exactly these kinds of financial decisions so you can make them with confidence. We'll see you next time.